Good morning, good afternoon, and for some of you, good evening. Welcome to our fourth installment of our webinar series on the Canadian hotel market. I'm delighted to once again be joined by our panelists who participated in the inaugural session exactly 1 year ago, and also in our third installment titled 90 Days Later, which we held in June of last year. Brian, Carrie, Dee, George, Mark, welcome back. As we have in the past, I'd like to set the stage for our discussion today with having Carrie do a quick highlight of market performance indicators. Carrie, you're on mute. Thank you.
Thanks, Alan. So I'm just going to give you a few stats. I'll blast you with a bunch of numbers, and if anyone wants to follow up and get specific so you're not rapidly jotting these down, just let me know. But so if we look back at 2020, occupancy ended the year at 31%. Average rate was $131. It was down 21% year over year. And so we ended 2020 with a RevPAR of $40, down 62% from 2019, which was a peak year for the country. Definitely differences between urban and small town markets. The urban markets were down 70% in RevPAR, where the small town markets were only down 40%. Overall, the demand decline was 52% year over year. Supply increased last year by 0.6%, and we'll probably talk a little bit about this today, but we expected supply growth to be over 2% last year, so it was measurably below what was expected in terms of hotels opening. No doubt the core areas, Montreal, Toronto, Vancouver, downtown, those markets were the most dramatically affected with RevPAR declines of 80% generally across those. When the market started to recover last summer, it was clear that the leisure traveler was the first to rebound. So we saw places like the interior of BC, parts of Vancouver Island, Northern Ontario. Those areas noted RevPAR declines for the year in the mid 30%. Rate declines were under 5%. So they were holding their rate for the demand that was coming, generally speaking. In terms of the weekly patterns last year, the worst week of the year was April 11th. Occupancy was 12%. We rebounded to the best week of the year, which was August the 15th at 43% occupancy. And then during the second wave at the end of December, the week of December 20th, occupancy was down to 17%. The last week, we just got the stats in this morning. Last week, we had occupancy in the country of 32%. So that's measurably up from where it was at the end of December, which is a good sign. Year over year increases, because now we're comparing last year in COVID to this year in the recovery. And we've got 142% increase in RevPAR week over week. So, it's hard to compare 12% and say that, it doesn't really matter what percentage you grow that. It's still a tough number to rebound off of. But mandatory quarantine is really a boost to the airport markets of Vancouver, Toronto, Montreal. Those markets are seeing both rate and occupancy increases that are pretty significant, almost 60% occupancy last week in all three of those markets. Certainly the vaccine rollout is going to be the game changer, and it looks like that is rolling at or ahead of schedule from what the government has been speaking of. So that's a positive sign. And despite this fact that we're seeing an uptick in cases, we're seeing a decrease in deaths and hospitalizations. So it's a positive sign that's going to give people comfort to start traveling once these health restrictions move forward. So it's still a ways to go to get back to the 2019 numbers, and we'll discuss what everyone's vision of that is. But that's where we're at today, and at least we're going in the right direction.
Great, Carrie. Thank you very much. Well, here we are 365 days later, and the hospitality industry has been battling significant headwinds. We're grappling to strike a balance between fighting for recovery and planning for the expected pent-up demand. I think it's appropriate that we begin our conversation with getting each of your views on the anticipated recovery, what you think it'll look like, and timing. But before we do that, I thought I'd highlight some of the predictions that were made March 31st, 2020. So someone was talking, and I'm not going to mention names, right? So someone had mentioned a V-shaped recovery, Brian. Then there was a comment about this is short term, 60 to 90 days, we should be back to normal, D. And then there was also a comment about we're not trading on rate, no discounting, Kenny. And then my co-host, Mark, oops, I wasn't supposed to mention names, was talking about a third of the lenders being active through this period. And then, of course, can't leave you out, Kerry. Your prediction was, I think, a 35 to 40% decline in RevPAR, and I think you just quoted 62%. So listen, in all seriousness, we were a mere 20 days after the World Health Organization had declared COVID-19 a pandemic. It was our best guess at the time. I think we were brave in coming out and doing this 20 days into it. And, for that, I truly appreciate you guys participating and continue to participate, because I think, as we've seen through the series of webinars that we've had, I think it's invaluable. I should mention that we had over 1,200 people register for this webinar, and I think a good number have logged in. So with that, I'd like to start off with your predictions or your views on the recovery. And I think it was, again, not naming names, someone talking about a V-shaped recovery. Can I have Brian start off with what his outlook is?
Well, V's can come in different forms. I mean, some decline very sharply and then take a little longer on the other side. In the early days, there really was not a lot of clarity around the virus and how long it would take, before we came into recovery. As the year went on, it became much more clear. I think where we are today, there's definitely more consensus and more clarity, I think, around the recovery. I think it's a modern miracle with the vaccine, and that clearly is going to drive any recovery that we see. To Kerry's point, leisure, I think, again, this year will be very strong. I think anyone trying to, book a cottage or a time at a resort this summer is going to have a hard time. So there's a tremendous amount of demand in that sector. While we've seen increases in vacancy from some of the other demand generators that we look at, like industrial and office, there was negative absorption in office last year. But going into 22 and 23, we're actually looking at very strong levels of office absorption. Industrial really hasn't even skipped a beat. Last year, there was millions of feet absorbed coast to coast, and that'll continue. I think industrial vacancy across the country is only sitting at 2.5%. So I think if you look at those indicators, I think those bode well for the hotel sector. And of course, that also is reflected in the GDP numbers looking forward. Very strong growth predicted this year and next year. So I think it likely is a 2 to 3 year recovery. Some segments will recover a lot faster. Others may take a little longer. I think those large conferences may take a little longer just because of the lag time. But domestic, international, I think will return in the next couple of years.
That's great. I think, Brian, you're right. Getting the vaccine is really the silver bullet to resolving this crisis. So let's switch to the owners and operators on the panel. And Kenny, Dee, and George, why don't you give us your view on the recovery and specifically what you think timing is going to how timing is going to pan out and what it's going to look like. So, Kenny, do you want to start off? You're on mute.
Sorry, not to mention any names, Alan, but when it comes to predictions, I think somebody said that deals were really going to start flowing after 90 days last year. So, I think where we're seeing more demand, it's certainly not moving in the direction that we'd like or as fast as we'd like. But I think we see the secondary and tertiary markets recovering quicker. Urban hotels, airport hotels, except for those that have the quarantine business, are going to be the last to recover, I think, and particularly big meeting hotels. We're kind of, our view is that we're going to see a recovery sometime in late 23, early 24, I think is our view.
I don't know, Alan, to make predictions, if we predicted a year ago, March, we were all wrong, right? I mean, we thought it'd be
relatively,
including you. I think you were wrong too. But I think the question is maybe to Kerry and Brian is that we hear about the Roaring Twenties coming back, right? And what are your thoughts on that when you do the analytics from your point of view? And we're hearing that very similar things happen in the 20s, and we're now in 2020s, and we're looking at the banks have an all-time liquidity in the banks. The balances are all-time high. It's, the government put out $300 billion out. It's sitting somewhere in the banking system or somebody's balance. So is that going to stimulate demand? And are we going to see a V-shaped Roaring Twenties, Kerry?
Well, I don't want to be pegged with the V-shaped comment and be wrong again. But having 20 plus years of doing predictions, we're always wrong in some direction. I think that one of the things that we've noticed through previous cycles, and there's been studies done on this in terms of people that have to do predictions in the industry, is that we are often surprised by the downside. So it's worse than we project it's going to be, but often the upside we're slower to predict the upside. And I think to what you're saying, Dee, about the Roaring Twenties, there's a lot of pent up demand for travel. There's budgets out there that didn't get spent. I'm just speaking of associations and different types of groups. There's obviously the leisure segment that they want to come back and travel. And I think the psychology is going to be that people have been very close to home. The next few years, once we are vaccinated, there's going to be a lot of people that are looking to enjoy life in a different way than they have in the last year. So, I don't want to be overly bullish on the numbers, but I think that we do have a lot of potential to recover. It's just really a question of that international group market. When can that come back? When will we have the borders freely opened and have that level of travel to create the compression, which is going to drive everything else? Because the leisure traveler is going to come back. They showed that last summer. They're showing that, they closed Whistler this week because there was activity that was just, too much to sustain in this environment. So the leisure travel wants to be out there. They will be out there as soon as it's safe to do so. The corporate traveler, I expect this fall, we're going to start to see significant corporate travel because the majority of people are going to be vaccinated if they want it to be. It's the group market that'll create the compression.
Great. George, do you want to?
Yeah, just speaking about the group market, meeting planners are inquiring about Q4 right now. The uncertainty that they're experiencing is just what are they going to be allowed to do? What are group sizes going to be approved? How quickly are the restrictions going to be eased? And I think we need some clarity from various governments on based on the current vaccine rollout scenario. I think there needs to be some communication of when an estimated timing of easing of restrictions. And I think that's on incumbent of governments to do that sooner rather than later. I think that will help with some confidence in booking group business into the fall. But I had a call this morning with Bettina and Michelle from Ariel Bank, and they talked a little bit about Israel because they have clients and loans in Israel. And I think it's a good benchmark for us to consider because they're ahead of everybody in the world in terms of vaccine rollout, with all adults having at least one vaccine and 60% of the country fully vaccinated. So what I heard from Bettina is that they're back to normal. Everything is open. And it's business as usual in Israel. And they're really only a few short months ahead of us and most other countries. So I think our eyes and our Canadian hotel industry's eyes will be on their hotel industry specific performance in Israel in Q2. I think that will really give us some clarity of what we can expect because we're not that far behind them. It's interesting where we have in Canada 4 times as many people as they do in Israel. We have similar number of COVID cases. We have about 1 million. They have 800 and some thousand. Their peak active cases was 85,000, same as ours. But as their vaccines rolled out, their active cases just took a steep nosedive. And they're down to, I think, about 8,000 active cases now. We've ticked back up to 47,000. But as we vaccinate more, look for that that steep decline to happen, the confidence to happen, and people to get out traveling by the summer. I think the leisure business in the summer is going to be strong. And once there's clarity of what people are going to be allowed to do, group business will start to come back. It won't be back to where it has been in the past in Q4, but we will get some business back in Q4.
It's great.
Alan,
Thanks, George. Sorry, Brian, go ahead.
Yeah, sorry, I wanted to mention when I reference those other sectors, I mean, I think those are good indicators in terms of office expansion. So in 23, they're looking at about 12 million feet of office being absorbed. And, you know, and employment growth is certainly still quite strong after this year. And I guess it's important to remember that, you know, this really was a health crisis it's led to a bit of an economic crisis, but the economic fundamentals in many ways are still good. And that's pretty clear when you look at the data for industrial expansion, office expansion. Another sector I think that's somewhat related is, you know, retail. Retail also took a hammering last year, but the outlook for retail is very, very strong going into the end of this year and next year as well. So I think hotels will reflect that to a certain extent as well, just that pent-up demand that Carrie had mentioned and George.
Yeah, that's great. Thanks, Brian. And on that positive note, why don't we just switch the discussion to the debt markets? And, you know, as we're starting to see lenders get active again in the hospitality sector, perhaps we can have Mark give us, you know, an overview of what he's seeing and start that discussion off. Mark?
Yeah, thanks, Alan. And hello, everyone. Now, based on the rollout, lenders are feeling cautiously optimistic. We are seeing more lenders financing hotels today compared to 6 months ago. And with ongoing discussion with all of our lenders, we expect more returning in the near future. Financing is available for construction, acquisition, and refinance, and we have been funding all categories during COVID. The commonality for lending in this current environment is to carve out the principal and interest from the loan for the number of months one expects the market will return, depending on location. i.e., so secondary markets may be 6 to 12 months. If you're in an urban market, more dependent upon the corporate travel, is 12 plus months. But that seems to be a fairly consistent trend with the lenders, which does make sense. You're kind of carving out that guesstimate on the recovery for the pandemic side, and as long as the lenders are more secure on making payments and hitting that service coverage with the reserve capital, then you're focused on the forecast post-pandemic.
It's great. So let's get the perspective of the owners, and you know, I know you guys in various forums have been either on the buy or sell side in the recent past, and perhaps Dee, if you can give us your sense of how the lenders are reacting to both the sell and buy side, and then we'll get other Kenny and George's perspective, and then jump to Carrie and Brian just from an advisor's perspective. So Dee, if you want to just give us your thoughts on that.
Yeah, listen, Alan, we've had a few transactions just closed today, and they were not easy. Lenders are out there, but on a very selected basis. We're seeing ratios of 55 to 60%. We're seeing interest reserve. We're seeing a little cost of funds have moved up by 50 basis points in the last 1 month. The bonds have gone up. So it's challenging, but I think if you're the right buyer or right seller, when the right covenants, there is financing available from few institutions right now. But you got to pay. If you got to make sure your covenants are in line, your interest rate, and you got to communicate to your lenders. And I think if you do all that, there is liquidity available, but on a constrained basis. That's what we're looking at right now.
Kenny, you want to shed some light on that on the debt markets?
Yeah, I agree with Dee. I think the folks that strong sponsorship is not going to, if you're a strong sponsor, debt is available, although it costs more, the interest reserves, lower leverage. We're seeing the same thing that Dee's seeing, not a huge difference there, but debt is available.
Okay. And George?
Yeah, I would agree with the comments that both Kenny and Dee made. We closed a loan on 2 hotels earlier this week. I don't know if everybody saw the CFO press release, CFO Capital press release from earlier today. A $48.5 million loan on 2 East Coast Delta properties that were under-levered. So we had some trapped equity in there. Terms were pretty favorable. We were provided net proceeds of over 16 million and a creative revolver, to Dee and Kenny's points, of $5 million will cover the next 2 years interest and principal. So, that was good for us. We also extended with an existing lender for a 1 year term. They want to renew for a longer term, but they just want some more clarity. So they kicked the can down the road a year on an interest only basis, which was nice for us. And I have heard from some lenders who feel that currently their hotel loan portfolio is in better shape than it was during the 2008 and 09 crisis. To quote Bettina from Ariel Bank again, who I believe was quoting Christoph, their hotel loan portfolio requires work but no worry. And I think that's a good place to be when you're a lender, and I think most Canadian lenders will find themselves in the same boat.
Alam, I think history is very important, right? If historically you've been good with the institutions, it's a lot more easier. The parameters have changed. The challenge is getting the right appraisals, Brian, which can be challenging. But I think they're looking at pre-COVID and then looking at a year 23, 24, 25. Based on that scenario, I think that there is funding available, and the banks and institutions have to lend money. They're sitting on a lot of liquidity, and they don't make money sitting in a bank account. They're going to get returns. So I think hopefully our industry is going to get good favorable reviews going forward with the recovery, and I actually do see a recovery happening. The caveat about the variance and international travel is still there, but overall, I think we're trending in a very, very positive direction.
Well, that's a segue into valuation, and I wanted Brian and Kerry's views on the debt markets, but I think that dovetails into the discussion on hotel valuation. And I know that 365 days ago, and even when we did our third webinar I think it was the end of June, we were struggling with where valuation metrics were and what the relative discount was to pre-COVID values. I think the perception was that the investment market was looking for that 20 to 40% discount. I think there's clear evidence that didn't happen, and here we are, in a market that I think we're starting to see some real traction, both on the debt side, as you guys have all talked about, but also on the equity side with people wanting to put money out. So from a valuation perspective, Brian, Kerry, would love to get your thoughts and views on how you guys are dealing with valuations today.
Sure. Kerry, I'll start, but jump in. I think we do look at these pretty much the same way, but looking at obviously current performance, current earnings isn't particularly helpful in estimating a value. It was very challenging in the early days. To your point, there was just a lot of really divergent opinions on where values were, and yet we had really no benchmarks to work with. I think at that time, everyone decided that a longer term view is appropriate. Clearly, we expected a quicker turnaround. It's taken a bit longer, but I still think you need to look at the investment over a suitable horizon. And what that does is it lets you account for those lower cash flows in the next 2 or 3 years. And the other thing it does too is that you can also factor in any concessions. I know some of the brands have given concessions, whether it's on fees or capital requirements. And so that can also be factored in when you're looking at a longer term cash flow. So now that we are beginning to see trades, I think that approach has been validated. I think that, the majority of the drop in value really is contained in those cash flow shortfalls in the short term. And I think, we certainly believe, and most people in the industry believe, we'll get back to those 2018-19 levels in the next 2 to 3 years. What's key is to understand where the value will be once things stabilize. I think buyers, investors, lenders really want to understand that part of it.
I would say that when we were talking a year ago or even the 90 days after, we were still wondering what the parameters, is the discount rate going to go up materially because we've experienced all of this shock and risk in the sector. US is more prevalent in the number of surveys they put out, but we're not seeing a huge premium added on because of this environment. So it'd be naive to say that values haven't adjusted to some degree, and I'm sure there's potential buyers on this call looking for opportunities, and they're not looking to pay what hotels were worth in 2019. So there's some adjustment in there, but it's more related to cash flow and this build back up to where we were than it is to significantly higher discount rates or ultimately terminal cap rates in the longer term.
So,
So
Carrie,
no specific predictions from either one of you that I can quote you guys on, right? Next time.
We're way smarter this year. Way smarter this year.
Brian and Carrie, I have a question as well. So we're seeing a big demand, not big demand, we are seeing a demand right now for construction to come back. There's a fair amount of hoteliers that basically site plan approved, ready to go. I guesstimate 1/3 of our projects that were in the pipeline, they're now coming back to the market saying, hey, now's the time to start. And obviously we're getting updated valuations. We're in the middle of that right now, but they're saying if I can get the capital today and start in the spring, then by the time we're opening, we're hoping to be in good shape. What have you seen looking at today, pre-COVID construction values versus today? Now they're 1 year out. Do you think the value pre-COVID on a stabilization is different if we start the construction today?
He's looking for a prediction, guys.
He wants to guarantee that the number he got last year is the same number he's getting right now.
I'm okay with 1 or 2% variance, but just
1 or 2, yeah. Well, I mean, certainly if you're looking down, you get a hotel that you're in the planning stages and you're opening in 24, 25. We see COVID being in the rearview mirror in terms of the cash flow issues. The other variable is that a lot of these markets, like we were looking at 2.2% increase in supply for last year, this year, next year, in terms of all of the stuff that was in the pipeline. This is going to change the supply picture for the next few years, which could be positive to some projects. So I certainly don't feel comfortable saying that the numbers are the same, but there are certainly arguments on both sides that are going to help that you're not getting a severe haircut on what the proposed project was and is today.
So let's start from supply that. Brian, sorry, I think you were one of the things I was going to lead you into is the discussion on supply, because I know you've looked at the numbers, and I think based on the inventory that we've seen, there's probably about a 2,000 room reduction in supply. So I don't know if that's what you were going to talk about, but I'd like you to address that as well.
Yeah, just before we go to that, Mark, I think it really is case by case. I can give you an example. We were looking at a project in the GTA middle of last year. We had done work on it in 19. It looked pretty positive. They came back last year. It didn't look so good. There'd been some new supply that was in the pipeline. There was a local major demand generator that looked like they were going to be shutting down some operations. And I spoke with them earlier this week, and it turns out 2 of those new supply properties have been canceled. And there wasn't a major announcement from the local demand generator. So I think you really got to look at it case by case. What's the supply situation and what's happening just in terms of demand generators?
So, Mark, a question for you. Sorry, Dee.
Sorry, I was going to say to Mark and maybe comment that I think everything right now is also regionalized too. Like if you're in Alberta, it's a different market, absolutely, completely. And if you're in Atlantic provinces, the bubble, it's a different market right now. If you're in the downtown markets and major centers, a different market. So for construction or for new value, listen, everything is great, but there are some headwinds as well. We need to be aware of. The headwinds are that the costs are going up, right? The labor costs are moving up, utilities are moving up, the cost of financing is starting to move up by 50 basis points on cost of funds. So whilst there's construction and all of, at the end of the day, where is this going to shake out? Because even if the revenue comes back, are we in a situation where are we accounting for the increase in labor costs and utilities and insurance premiums and property taxes will go up because the municipalities need to get money back? How will that impact future construction and the valuation? That's what I'm sort of looking for Brian and Carrie to tell me that, right?
Mm-hmm.
Yeah, absolutely.
So Mark, I have a question for you. So in the lending environment, do lenders have more of an appetite for urban, say, versus suburban, secondary markets or tertiary markets, focus service, full service? Where do you see the lender appetite these days?
Yeah, great question, Kenny. I think to even Dee's point, you're welcome. It's really specific. So depending if the asset makes sense, the key component is the valuation should be at or above the cost of construction. And the cost of construction today is even more pre-COVID that we're seeing the numbers are rising. So as long as the appraisal or feasibility study is at or above, then it makes sense, along with the sponsorship. Liquidity is also very important. So even the hoteliers that have made one or two hotel, financing is still available on the construction side for them, doesn't matter which region, but understand the liquidity just in case the weather any further storms as well.
So Mark, Kenny, if you guys want to have a direct discussion, maybe do it offline. So why don't we?
Alan, just on the values, just from a seller's perspective, just before we move on to another area, we're in the market currently selling 3 hotels. They're all under contract. 2 of the hotels are for alternative use, and we're selling those at a price higher than pre-COVID values. So I think that, there is some alternative use, some sales happening for alternative use at good prices out there. The 3rd hotel we're selling, and it will stay as a hotel at a pretty reasonable discount to pre-COVID values. So, and then we actually have an unsolicited offer on a 4th hotel, again for an alternative use that once again is higher than the pre-COVID value.
I think the alternative use that was one of the themes of last year. We tracked about 20 sales, George, last year that were alternate use, either redevelopment or conversion to social housing, which was about 2,000 rooms altogether. And the average pricing on that was $240,000 a room. So it clearly wasn't trading as hotel. So that I think we'll see more of that. We're certainly aware of a few transactions that are still in the works where municipalities are buying hotels for social housing.
From a debt perspective, sorry, Brian. And from a debt perspective, we're involved with the alternative use as well. And it's the lenders, depending on the asset class, we're up to 85% of total costs of acquisition and CapEx provide the valuation on a stabilization value is a lot higher. So there's, from a debt perspective, it's also very aggressive.
So George, Brian, I think that was a good segue into transaction activity because, as we know, 2020 was probably the lowest levels of activity. There was just under $900 million of transaction activity. And Brian, to your point, it was 51% of those transactions were alternate use. So it was part of the Rapid Housing Initiative, agencies buying for alternate use. But there was also a shift of hotels that were trading for traditional alternate uses, so not just for the shelter business or the vulnerable. And I think that like you said, I think there's going to be a fair amount of that activity this year as that $1 billion Rapid Housing Initiative rolls out. But I think from a transaction activity, one of the green shoots that we've seen, and I think we have to look at the U.S. and look at what is happening there. One of the positive signs that a couple of significant transactions that have taken place there that I think shows a significant commitment to the industry is what Colony Capital's sale of their 6 portfolio focus service assets to Highgate and Cerberus. That just closed. You've got the pending sale of Extended Stay America to a JV between Starwood Capital and Blackstone. These guys are seasoned investors in the sector that are committing their capital towards the focus service and extended stay segments. So, when we talk about the segments that, I think, Kenny, you made the point, what segments are seeing the most activity? I think that that is one indicator there. So to that point, as Dee said also, I think it is regional based. But Mark, from your perspective on the debt side, for pure hotel acquisitions, how are lenders, I know you touched on it earlier, but how are lenders underwriting? And, obviously the focus has always been on the borrower, but, can you touch on that?
Sure. So if it's an existing asset, you look at the pre-COVID numbers. So as long as you're debt servicing the loan amount you're applying, As long as you're debt servicing pre-COVID numbers, then it's one step to move forward. Number two is, in theory, you're going up to 65%, but that 65% I mentioned beforehand, they're still kind of carving out that P&I during during the period of where they feel the COVID is going to recover, the 6, 12, 18 months. Amortization is the same. Interest rates are slightly higher on the spread side. That's basically still the same support, just carving it out protection for the bank on payments.
And Dee, I know you have been active, and so have you, Kenny, on the acquisition side. George, I know you guys are much more selective, just given your portfolio. But on acquisition financing, you both touched earlier on, and again, I'm not looking to get specific to the deals that you're looking at, but is there a general appetite out there?
Yeah, I think on the right transaction and the right sponsor and the right reserve for interest, there is an appetite for not the 75%, but 55, 60% is available from, and it's only a handful of institutions, unless Mark has got some more, which call me if you have any, Mark. But typically I think it's 2 or 3 banks and maybe a credit union. I think that's who are in the market right now. But there is appetite. But I want to point out one thing, Alan, which is on valuation. There definitely is an adjustment of between 10 to 15% minimum. I think we're seeing that everywhere. We had a portfolio under contract before, and we had a 10-15% adjustment on that. But on the flip side, we had 2 properties in Florida, which were under contract pre-COVID for $85 million. So they went off the rails, and they came back at about $70 million. And last week we put them under contract, firm contract at $83.5 million. So only $1.5 million discount on an $85 million purchase price. So again, it's Florida, a lot of capital chasing it. So there's a lot of pool of capital in the USA, and I feel that the same pool of capital locally and within Canada is developing, and there is a lot of capital waiting to be deployed. So I think prices will firm up a little bit, but they will still looking for some discount depending on what market you're in, I think so. And it is available.
I think we got our first prediction there, 10 to 15%. So just for the record, we're gonna make a note of that, which is great. And Dee, I think just based on evidence that we've seen in assets that we're selling, I think that discount level is definitely, in all seriousness, I think that's the kind of level that we're looking at. George, you alluded to other transactions, traditional hotel transactions. I think that kind of is in line with what we're seeing. So gone are the days of the expectation that there was going to be that 20-40% discount. I think, we all know that there's particularly in the US, there's a tremendous amount of institutional capital that's been raised more than ever before. I think the Canadian context is, much more private capital that is chasing this type of product, because we have very little institutional capital that is invested in our sector. It's just because of the size of the market. But I think that, I totally agree with that 10 to 15%. I think for anyone to think that there isn't a discount relative to pre-COVID values, I think is you're not factoring in that cash flow drain that is going to happen, that has happened in the last 12 months, and that will continue to happen for the 12 to 18 months.
Kind of depends on whether you're a seller or a buyer on your view of discounts, right?
Yeah.
So
and also every month that goes by shortens the time to when we're going to be back to normal, and so values are just going to tick up as every month passes.
I don't know. Hold on, George. What happened when your Qs drops off, when CERS drop off? We've been surviving last 12 months on government money. I mean, let's face it, if that Qs was not there and CERS was not there, a lot of us, including myself, and a lot of hotel owners will be in deep trouble right now, right?
Yeah, but I think that's a different discussion.
Perfect segue into the government subsidies, because I know this is near and dear to your heart, Dee. You made it known on the 90 Days Later webinar, and I think people were very appreciative of that. But I think you're absolutely right. If in the absence of those government subsidies, and it's about $11 billion in liquidity relief that hospitality sector has gotten through Qs, CERS, and the new HASCAP loan. I think we heard from you guys on the usefulness or the utility of the BDC EDC program, and D, you were loud and clear in your views on that. But let's talk about the new HASCAP loans and the what happens if these subsidies fall out at the end of June, which is what is currently the plan, right?
No, Alan. First of all, let's unite together and write to our member of parliaments and ministers and everybody to make sure that our industry, they continue to support us until another 12 months on this queues, and because we will need that. I mean, as much as we're saying it's going to be business is coming back, which is true, but I think Ontario is going into a lockdown in the next 48 hours for the next 2 weeks. So, and until the variant is under control and international travel is under control, I think we should all collectively as a group lobby our various different governments to make sure that queues and SIRS continue for another 12 months. And I think, if there's an election going to be happening, we should be all more so demanding. Hopefully, they put in the next budget on April 19th. So
that's another prediction there, Alan. So
I know that. So again, to your point, D, what happens if there is another lockdown and if the subsidies don't continue? How do you navigate through the zero cash flow environment? Right? Are we going to see more distress? What are the views of the panel?
I think we all have to then also work with our institutions, financial institutions, right? And I hope the lenders are listening that, we may need to get into another principal vacation for 6 months repayment, because right now the queues and the SIRS are supporting our operation. In absence of that, even if business does come back, I'm not sure it's going to come back booming. Hopefully it does come back to roaring 20s, but we should be ready to have those frank discussion with your lenders to defer principal again for another 6 months or 12 months, because we're going to need it. We are going to need it because costs are going to go up. I mean, we're having a great trouble getting people to get people come back to work, and when we're seeing that there's going to be a pressure on wages, if there's an inflationary cycle, we're going to see pressure on cost rising. We're going to see cost of funds going up. So if all that is still out there and could have an impact on valuation. So one of
the points I'd like to make is that we didn't, a year ago, we may have been predicting 30% value declines, but we didn't see them because we didn't have distress in terms of people having to go to the market and sell in that environment. We had huge government subsidies that came in very quickly. The Canadian lending market is as it always has been, a real relationship game where they were taking care of their clients and didn't want to pull assets back really quickly. So I think the fact that we didn't see the decline in value was a real function of all of the support that was there for the industry. So if that support comes out and we don't see a recovery at the pace that we are hoping because of the vaccinations and everything that's going on, there's still potential for distress ahead of us. And the fallout of some of this tends to happen a little further down the road. So, there's a buildup of this liquidity that people are going to have to pay back at some point. They've pulled out all the capital out of their reserve lines. There's a lot of money that still needs to get paid back once the cash flow can support that. But 2024, when we're sort of in somewhat agreement that we're back to normal, is a ways off. So I think that we will see some transaction activity happen just because of that. People are not going to put more money into some of these assets.
I think you're also going to see what we call fatigue selling. People like maybe myself, we're getting to an age where we say, no, I've had it, I'm done. I'm going to rationalize some assets and just sell out. You're going to see some of that. You're going to see people like George with Invest wanting to rationalize some of their assets because, they don't want to put capital back in or whatever reasons may be out there. But there's going to be, I think, what is known as fatigue selling. People are tired. They want to move on. Their generation are changing. So I think that will also determine what the valuation will be, because some may just want to sell it, that they've had it and move on, right? So I think that equation is still playing out, and we're seeing that in some portfolios happening as we speak.
Yeah, Dee, I think that's a very good point, and I think we have started to see evidence of that whole rationalization. Focus on the assets longer term, or people getting out and actually divesting of assets so that they can get it more into a diversified portfolio. And Kerry, to your point about the delayed impact of of distressed selling. I think clear evidence is what we saw after the global financial crisis in 2008. It wasn't until 2010 that the level of distressed selling occurred, and that was 2 years after, right? And was up to 12%. Whereas if you look at 2009, when you would have thought that distressed selling, it was a mere 3%. So I think that's a good point. I again want to shift the discussion because last time around we didn't get to spend enough time talking about operational changes and brand standards, and I think it is an important thing. And I think a lot of people that are listening in wanted to hear your thoughts on how you're going to be grappling with that, how brands are dealing with that. And so with that, let's shift to the owners. And George, perhaps you can give us your thoughts on these operational changes that you're navigating through and what you guys are planning for.
Yeah, you've heard sayings like recession is an awful thing to waste. Well, a pandemic is also an awful thing to waste as well. So I think we're going to see a new operating model, more efficient hotel operations come out of this. And I think it's ultimately going to be the silver lining of the pandemic. Governments across the country have cooperated with businesses that have had to lay off employees for extended period of time without requiring the payment of severances. So that has definitely helped the liquidity of our industry. But I know our operations and asset management teams took a bit of a contrary approach to deferring severances in a number of cases. Even though we could have, they took a hard look at the operating structure at every hotel. And we ended up investing several millions of dollars in severances across our portfolio for people who were close to retiring and needed a bit of an edge, for people who wanted to move on to other industries, and for positions that we thought we could do without post-COVID after a good hard look at our operation. So for several millions of dollars we spent in 2020, we severed 650 employees. Eliminated nearly $30 million in annual salaries and wages, or approximately 13% of our pre-COVID overall payroll. Our expectation is that these positions will not need to be replaced when business returns to normal. But even if half of these positions do creep back in over time, we will still have generated over $200 million in value, or nearly 10% of our pre-COVID values. So, we have a good chance of returning to pre-COVID values quicker and hopefully surpassing those values in the years to come. The goal is to return to 2019 profits without returning to 2019 top line levels. And really, this change in the operating model to improve efficiencies, we think, is the silver lining of the pandemic.
And let's talk about brands and some of the brand standards and how you guys are dealing with that, and what you see transpiring over the next little while as business starts picking up.
Yeah, I think we're just getting a lot of cooperation from the brands. I won't give you anything specific, but some were just allowing us to defer FF&E contributions for the whole of 2021. We're just getting a lot of patience and understanding, where we're in current PIP cycles where we haven't been forced to do the work, and we quite frankly don't have the liquidity to do the work, and it's going to take some time for us to build our liquidity back. So this cooperation is going to have to extend past when business gets back to normal, because we're going to need a period of time to stock our shelves with a bit of cash again.
I think brand and owners are both working together to evaluate the silver lining, what George was saying. Do we need to have housekeeping for people to think for 2 days or 3 days? Do we need to have breakfast, buffet breakfast any longer? What can we do collectively to reduce cost? So I think the brands have teams that are working with ownership groups to try and find ways and get silver lining out of this pandemic, to say, do we need this, and why do we need it, and can we save money? I think so. We're saying that for the first time in the last 12 months that we are aligned in our thought process in terms of getting value for our brand, right? So I think they are working together. Some are taking their time, but I think most are getting there where they want to work together to become more efficient, whether it's in delaying PIP or PIP cycle or breakfast or housekeeping or amenities or whatever the areas may be. So I think we're seeing that.
Yeah, brands want to get back to where they're earning incentive fees again, and incentive fees are a good thing when you're paying them because your hotel is very profitable, and so that's why we're getting a lot of cooperation. They've lost those incentive fees to their management contracts, and they want them back.
Kenny, I think you were about to say something earlier.
Yeah, look, we've seen, literally across the board with the brands, cooperation in all of the things that Dee and George talked about. I think as it relates to the brands, a lot of it revolves around guest service and how you service the guest. And a lot of times the brands have very rigid requirements as it relates to that. And I think the elephant in the room as it relates to whether it's brands or how we operate our hotels is, I think going forward, labor is going to be the number one issue outside of kind of business recovery. And labor is going to continue to be expensive, hard to find. And I think that's where the brands have some flexibility in the things like housekeeping and free breakfast or breakfast buffets and that kind of thing. So.
Alan, I wanted to ask, George, you mentioned about these cuts. Where was a lot of that focused, or what areas was that largely focused in? Is it sort of mid-management? Is it around F&B? I got to think F&B is one area that's going to see some significant changes.
Yeah, a lot of it is middle management positions where, we took a hard look at positions and found out there were duplicative or redundant. A lot of salary positions, and we found more opportunity. The more employees you have, the bigger the hotel, the more upscale it is, the more opportunity we found. We found some opportunities in Comfort Inns, but not a lot. It's mainly at the big full service hotels that have, just a lot of staff.
Yeah, we were, George, we were able to realize some savings in labor from pretty much all of our hotels, whether it was a 60-room Comfort or a full service 300-room hotel. So we took maybe a little bit different approach, but we were able to realize some level of savings across the board, whether small or big hotel.
Yeah, same with us. Every hotel had some opportunity.
So, guys, we're nearing the 2:00 mark, and I want to take some time to actually ask each one of you one question. If you reflect back on 12 months ago, what your thinking was and where you are today. I think for the participants on this webinar, I think it would be real useful for you to give us your candid views on, what your thinking was 365 days ago and where you are today, because I think that would be valuable for everyone. So, Dee, do you want to start with your thoughts?
Yeah, sure. When this pandemic broke out at the end of February, first week of March, I remember regrouping my whole team and actually pretty scared, right? In terms of, we had no idea what was coming down. We were looking at business shutting down. We're looking at maybe potentially filing bankruptcy. We're maybe potentially looking at burning $2-3 million a month. And we'll look at our liquidity, say how long we're going to last. The saddest part was when I stood in front of my head office and had to lay people off on March 15th. It was devastating because, we spent so many years building up your team, building up your culture, building up your people, and then having to just disappear in 1 week or cut back, and then we were all hopeful that it's going to come back in a few months, and then reality set in. It wasn't going to come back. We were scared. I was panicking internally because of uncertainty. And over a period of time, we got comfortable with the way the virus was going. We were thankful the government programs kicked in. We took some decisions which we normally would have by taking some alternative use for hotels to maintain our cash flows. The burn rate became a little less because of queues, surge, and we get more confident. We're managing to trim expenses in labor, garbage pickup, heat, light, utilities, whatever it was. Every single line was examined, which to George's point, there was a silver lining that we were able to re-examine our entire business strategy. So, we misread. We thought we were going to be back in 6-9 months. So obviously, then it happened, and here we are, 12 months later. I'm little bit more comfortable with where we are. I think the burn rate is not as much as what we had anticipated. I hope that the government continues with their program so that we'll continue to see us through this on the other side of the river. And I'm comfortable that we are going to come back, and we're going to come back strong. And I think maybe not this year, but maybe starting mid-22, I think the Roaring 20s will come in. I'm comfortable thinking that way. And I think we're going to get up now for the next 12 months to get ready for the Roaring 20s, mid-22. That's what we're looking at now. So that's my take.
That's great, Dee. I think, a couple of things, observations that I can draw on from what you had told us in the first webinar. In all seriousness, so that your main focus was on containing the damage, and I'll quote you, and preserving liquidity. I think that was one thing, and the other learning that I think you gave a lot of us in the industry was that your metric of $1,000 per room per day. I think it got a lot of people thinking about the level of liquidity crisis that people would be facing, and I think that was invaluable. So that's great. Thank you. And George, if I could turn it on to you, just on your thoughts.
Sure. A year ago, watching the cases sort of immediately, climb, and things shut down and everything. And then there was talk about, and then the summer was looking pretty good as cases started to drop quite dramatically. And, I actually very naively thought that this would be over, by the fall, and very naively thought that there wouldn't be a second wave. And even though, sort of the experts were talking about, are we going to hit a second wave? And it's remarkable that if you look back to the Spanish flu epidemic 100 years ago, how, we're basically experiencing almost, exactly the way they did. We fortunately, this pandemic is not as deadly as the Spanish flu, which has made people maybe not be as careful, not to catch it, which maybe is going to extend it a bit. But then, we've got a miracle of 40 years of research in these new types of vaccines that we're able to be rolling out. So, the Spanish flu took 2.5 years, and it's going to be close to that for us, even with the vaccines. We'll probably be a bit shorter than that. It's probably going to be 18 months to 24 months instead of 30 months. But I think we were naive, and I think we had history to look at, and we just didn't. We didn't, even though some experts did. But now you look back at the Spanish flu, and we're tracking very, very similar, and that's just how long it's going to take to get through this. But we are going to get through it. The worst is over, and every month that passes, the closer we get to this being over.
Great, thank you, George. And Kenny, any thoughts to close us off?
Sure. A year ago when we were on the call, I think we were really starting to and really working with our lenders, and the big question was, are we going to be able to get principal reductions or some kind of relief from the lenders? The government subsidies and that kind of thing was just still very preliminary. So people hadn't started talking about the relief that we were going to get from the government. So I think kind of as we go through looking at that, we think we're in a much better position now than we were a year ago. Even though the recovery's not there, we're starting to see a little bit of signs of it. And last year when this happened and the World Health Organization declared the pandemic, I went back and looked at past cycles, past events. So if you look at SARS, you look at 9/11, you look at the 08-09 financial crisis, everything recovered to higher levels, but it was a much shorter recovery than what we're going to see here. But to an event and a recovery, the recovery happened in 12 to 18 months, but coming out of the recovery, the top line and the recovery was much stronger than pre the event. So I think we're pretty optimistic about that. It's just a question of timing.
Great. So Carrie, Brian, and Mark, any closing thoughts? Carrie,
I would just say, to go from last year at this time, we were basically in a state of shock, right? We were all just taking it all in. You were paranoid about the health risk and then shocked to see what it was doing to our industry. So to watch how quickly almost humanity in general mobilized with a vaccine being shot into people's arms by December and government programs coming together in these short periods of time. It gives you a lot of hope for the future that we are such a resilient industry and community in general, right? Everyone kind of came together when they needed to in a way that you never would have expected. If we were ever to face some crisis in the future again, I think that it would be, with this in mind, that we can make it through to the other side. We do have the ability to be resilient. So.
And from a lender's perspective, the first real 6 months, everything was flat. Lenders trying to figure out what's happening to the portfolio, and really lending was kind of non-existent until they had some light. And what was happening at that time was several funds, institutional funds, created rescue capital. And that rescue capital, they've expected to deploy, they raised it. The returns are typically in the mid-teens in terms of an IRR. And again, waiting for that rescue capital to be deployed, but there's no transactions or refis or requirements to date. And as we progress, the institutional lending has been coming back with economic rates relatively. So it's a positive momentum.
I think, Alum, this time last year, to Kerry's point, this just came to a halt so quickly, and we really did go off the edge of a cliff. There was a lot of negativity around, the hospitality sector and retail, and a lot of divergent opinions. To your point, I mean, some people were suggesting, discounts of 50%. They looked at REIT prices and saw how far they fell, and why wouldn't the asset values follow? So it was very challenging to get, a bearing on where things were really at. But as we went through the year, and certainly where we sit today, there's definitely a lot more clarity around the path forward. And I think there's a lot of consensus around the coming recovery. So, and all of those, I think, bode well for investors, that they have a little more certainty about where this market's going.
Alan, just one further comment on government subsidies to add on to what Dee said earlier. Just a shout out to the Hotel Association of Canada, who've done a great job advocating for our industry. And we really do need the queues to extend, somewhat past June, even if it's at a somewhat lower percentage than 75%. It is a well thought out program. You only get it if your revenues are down from pre-COVID levels. So it's well designed, and it really, really has helped our industry and our employees. And it would be fantastic to see it continue for a period of time after June. So to Dee's point, everybody reach out to your MPs, and let's see if we can get this advocacy going for a little bit longer.
That's great. Thanks, George. And, I think if I were to sum it up, I think every time, I think you all said this in a different way, but every time there's a calamity, it seems like we come back bigger, stronger, and even better. So on that note, I'd like to thank everyone that joined in and participated in this webinar, and particularly the panel members. Appreciate you guys taking the time once again. I think it is testament to the number of people that we had registered. I think this time we broke the record. It was over 1,000. I think we got close to 1,200 registrants. And I really think it is a testament to your collective wisdom and experience that you are imparting to the industry. So thanks again, and everyone have a safe year ahead. Enjoy the summer, and let's start traveling. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.